and thank you for having me on your show to give a mid-year update as I see it. The name of our presentation today is Money Makes the Mare Go. Now, most of you know me as more of a short-term technical trader, but that doesn't mean that I'm not in there in the background purviewing all the drivers of the market. Now, when I first submitted my title, Money Makes the Mare Go, I got a query back saying, what does that mean? How does that work with this? And I wanted to answer that. This was one of the very first phrases that I heard on the trading floor back in the 1980s. I think that's truly the theme for the current environment that we are in and the main driver. Skip past the copyright notices, that mugshot of when I looked young and youthful, and let's move on to a quote from one of technicians that I greatly admire and respect, Marty Zweig, who wrote a wonderful book in 1970, Winning on Wall Street, that was updated several times, but he had a gem of a section in there on monetary indicators, and at the top of that was titled, Don't Fight the Fed. Okay, so we've all heard that, don't fight the Fed, but I thought this would be an appropriate quote to start off our little presentation today, because he was the one that also popularized Money Makes the Mare Go in this very first quote of this chapter. I want you to throw those fundamentals completely out the window, and I don't want anybody to question valuations at this stage of the game. And if you are questioning valuations, you need to go back and study what happened in the German hyperinflation with the Weimar Republic back in the early 1920s, when the stock market in Germany went up 20,000%. So put all this stuff out of your mind. So let's get down to the brass tacks and look at the main things that I look at once I am trying to foresee between just forecasting the next day. Okay, monetary conditions, number one, always number one. Then we take the existing monetary conditions and we look at the sentiment readings, because people are bullish when they're long and fully invested, and people are bearish when they're on the sidelines and not invested. So sentiment readings is another way of telling us how much cash has been put to work or how much is still sitting on the sidelines. And we're going to look at the seasonals and cycles, because all of these things have to do with human behavior, which is one of the things that we can count on as technical analysts and traders. And there's a very good reason as to why seasonals function the way they do, and cycles. And lastly, and not least of all, the momentum and the market structure, the daily, the weekly, and the monthly charts. First, I want to show you a slide that's going to start to make an impact as to how incredible the monetary conditions are right now. Now, nobody ever looks at M1. We have M1, M2, M3, and they basically touch on various aspects as to how accessible this money is to go into our stock market. So M1, just think of that as cash. All the M1 out there is cash in the bank deposits waiting to go into the markets. And look what happened here on the right side of this chart. An unprecedented historical acceleration in the monetary base in pure cash. What makes it so difficult and challenging to understand the current environment that we are in is that we don't have any past examples to really compare this to, at least not in US history. Okay, so what you're witnessing here is something that we have a sample size of 0. Okay, or basically 1. So we're dealing with an outlier event, an aberration, just as the pandemic was an outlier or aberration to the downside. This explosion in the monetary base is an outlier to the upside, and that is the primary driver for the second half of 2020. Let's look at M2 now. M2 is about 3 times the size of M1. It includes additional things such as retail money market mutual funds, saving deposits, and so forth. But let's go behind door number 3 and look at the global monetary base. This really puts it in perspective because, face it, we are just in one big global monetary cesspool sloshing around right now. And this probably should be put on a logarithmic scale for the percentage increase, but if it were, it would not make a difference. Okay, you can see the ginormous blip up that we had from the debacle of 2008 and all the monies that came in 2009. This is on a global basis. But look what has happened just in the last 3 months in a response to this one-off pandemic. So this is what we are dealing with right now as a driver, and it is going to be a tidal wave that swamps all fundamentals. So even if we look at China, which just last week increased their liquidity by 20%, okay, now we are seeing ways of injecting into the system that is different from the shadow banking increase in liquidity that we saw in China on those 2 previous parabolic spikes that we had in the last 12 years. If you study charts of Chinese ETFs or stocks, you will notice that there was this ginormous parabolic rally up, and we can't say how far these things go. Keep that in mind with our current environment. And then, of course, it was like a ski slope, and it just came right back down the other side. And my point to you is I don't think it's the same way this time, because this was a much more legitimate way of injecting reserves into the system. Now, where is all this money going? Who would have guessed that this emerging market ETF is now a relative strength leader on the global basis? These are all the things that technical analysis can do for us in terms of scanning and showing things that our cognitive biases would otherwise not believe. So we've got money going in all over the place, and I suspect that maybe a little weakness in the dollar could contribute to this rally here, but it's certainly an increase in momentum and acceleration, and nothing that you would want to short or step in front of. So now let's go down and put this in the context of sentiment, because that tells us some idea as to how much of that cash that we saw in those M1 and M2 and global figures is sitting on this sideline, and you have to think of that as fuel for the fire. So this is directly off StockCharts.com, and it is the most recent up-to-date reading. Okay, this was just this last weekend, and you can see here, oh my goodness gracious, where are these bulls? Where are they in hiding? And look at this high degree of bearishness down here. Now, normally it doesn't take much to see that when you see this amount of bearishness, and I understand that the random sampling technique of AAII readings is not ideal, but it's as good as anything. And when you combine this with investors' intelligence and a whole host of sentiment readings, it still is perfectly valid. So you can see high amount of bears here, fuel for the fire. High amount of bears here, fuel for the fire. Hello, gang. High amount of bears, fuel for the fire. I mean, this could get scary, okay? Scary if you are short or under invested. Let's look at some other things. We want to look at market structure. Now, anytime I look back on a weekly or a monthly chart, I'm going to put that on a log scale because it's much more appropriate to show the movement in terms of percentage move up or down. So that's what I've got on the right side here is a log scale on an S&P cash chart. And of course, we know that we've got new all-time highs in the NASDAQ. In fact, just yesterday, we had 47 new all-time highs on the NYSE and 75 new all-time highs on the NASDAQ. But here we are. I'm going to show you one of my favorite structures or patterns, and this works for any time frame, and it's where you get this ABC type of feeling, which is a consolidation pattern. And of course, I know we slipped on the ice here on this pandemic and goosed a little bit more to the downside, but let's just, for purposes of illustration, chop off that tail there because we did have a lot of shares that made higher highs during this period, this last sell-off, okay? But what you should look at is this oscillator where you see the ABC down, and it's almost like a reverse divergence. And anytime I see this formation, I know that there is a third leg up. So we should see one high, two high, and then we should get a third high. And I do not believe I'm putting price targets. I don't think we know where that's going to come in or what the duration is that it unfolds. Although I am willing to bet that the sentiment readings will tell us, because at that time that everybody's bullish and that AAII reading and investors intelligence and all these assorted tools that we have at our disposal register that the fat lady is singing, then you will know that you're at the top of this wave. But we are not there yet, so I have to remain very bullish. Now, we're in a special year this year because we have the presidential cycle. So this is courtesy of Stock Traders Almanac that they sent me this chart. It's up to date. It includes the latest data, and you can see, well, okay, so it's missing a week here. But it doesn't matter if the incumbent party, meaning the Republicans, win or if they lose. It just shows that we still have an upside bias in our election year, at least into somewhere the middle of September. And then, of course, if it's more apparent that the Democrats are going to have the upper edge, you might have a little bit of a reaction down. There's talk about changing corporate tax rates, etc., etc. That's noise, because we know in the big scheme of things, we are driven by these monetary factors. So overall, we're just concerned right now about our push in this third quarter, okay, up into the middle of September. And then we need to pull in our horns and exercise a little bit more caution. Okay, moving on. I love MRCI, More Research Centers site, for their wealth of free information, and they can show what year is correlating most with historic years in the past. So I looked at that, and interestingly, currently we are correlating most highly with 1980, which of course was another election year. Okay, so as you see, both years had a little bit of a dipsy-doodle here in the first quarter, but are recovering ground. And in 1980, an election year, we still managed to rally into that September window there. Okay, it's not a super high correlation, but the point of these correlation studies is to help us keep an open mind. I wouldn't necessarily mortgage the house and put a trade on based off that, but they help us keep an open mind that this is what happened in the past. All right, let's look at some other seasonals off of StockCharts' wonderful site here. This simply shows the percentage of time that the Dow closed up or down for a certain month. And you can see here, we're in this wonderful July period. And then we have a little bit of a dip down regardless of election year. September is not the craziest year, okay, but there's still a strong bias going into the end of the year. Here is another thing about seasonals. When the market is outperforming or underperforming a seasonal, that is powerful information for us. Now, let's look at this month of June. It's not normally a great month in terms of the seasonals, but this year we killed it. So the fact that we had such strong market performance during the month of June, which is normally a marginal month, is powerful information for us. So the next thing we want to start looking at is, okay, if there's all this money on the sidelines and all this sea of liquidity, what the heck do we do with it? Okay, where do we want to go? And we start looking at relative strength and things like that. Now, the first thing I want to point out is this super well-known overcrowded NASDAQ long seasonal trade. This is directly off of MRCI's website. July 2nd to July 23rd has this incredible long trade in the NASDAQ. Okay. I have seen so many people tout this now. I'm starting to become a little suspicious and getting ready to rotate out of some NASDAQ shares into the strength of this rally. And then I'm going to show you some other opportunities. So we still have a very strong seasonal bias. And here's what it looks like on StockCharts site. I love, love, love their seasonal module that lets us type in any symbol and you can look for any period of years back, 5 years back, 20 years back. But check this out. How crazy is this? QQQs, 100%. They close higher in the month of July, just looking back the past basically, 13, 15 years. I mean, it's pretty hard to lose with a statistic like that, okay? So just be conscious of that. Now, what I want to point out is that it drops off once you go into August and September, okay? So far we've determined there's still a strong upside bias. The momentum favors it, the seasonals favor it, the monetary conditions definitely favor it, and the sentiment favors it, okay? So we want to see how are we going to play this going forward. Very important. I want to also point out some other commodity markets because we came out with the PPI data today and it was showing, oh, no concerns whatsoever. However, there are sneaky things going on out there in these commodity markets, starting with copper, the most widely used industrial metal, and of course, a good source of the demand, over 50%, comes from China. And here we are. We still can get back up to the top of this 2019 range, and it still looks great to me. I don't see any reason why this copper can't just blast through this 300 number. So you have a very strong bid in some of these cash commodity markets. So I think that there's going to be a sneaky inflation out there. Probably not wage inflation, but a different type of inflation that can be even more insidious to the consumer's bottom line in the long run. Look at this lumber chart. Have you heard anybody talking about lumber making new highs? And in fact, this recent lumber contract here, the front month, has been making all-time highs. No, We don't hear about that, do we? And lumber is not the primary ingredient used in houses anymore, or I should say product, because, you know, in Florida at least, they're all built out of cinder block, you know, but it's a very widely used product come construction in one way or another. And it's only going to have stronger demand going forward for a number of reasons, which I will touch on very shortly. And lastly, everybody likes to rag on that poor corn market, which is suffering from like an overdose of supply. But is anybody looking at some of the sneaky prices, you know, with these other markets? Look at these oats. This is a beautiful uptrend, and it hasn't even gone parabolic. Now, if you look at things like the cows and the hogs and the sugar and the coffee and the corn and the wheat and the beans, these are all food products, very important going forward. There's never going to be a shortage of demand for food, only an increasing demand, and all of them are at extremely low historical levels. So they may not have started any huge uptrends yet, but they are unlikely to go down much from this point. So let's look at some individual stock sectors, okay? I wanted to give you guys a few choice ideas that weren't Netflix, which by now I think that horse definitely left the barn. And let's consider some of these areas: home improvement, home construction, internet, renewable energy, and non-durable house good products. Okay, household products. You know, my daughter is living in Chicago. She's pregnant, and they are looking desperately to move out of the city. And I will tell you one thing. Western suburbs of Chicago, whoever would have thought that this was such a hot market? It's crazy. I am seeing stuff go under contract within 2 hours of the listing period. Nobody wants to live in the cities. So my point being, the housing market is 10 times hotter than anybody is talking about in a lot of different ways. And if you can't afford to buy a new home, what are you going to do? You're going to fix up your little nest right where you are right now. So I think there's a lot of opportunity still in home improvement, in home construction. Internet's a slam dunk, but I'm going to show you one or two ideas that aren't necessarily Zoom. Okay, another horse that left the barn and is long down the final stretch here. And some other things just as we start to sneak up into that little election window. And for those of you that are noting that right now, currently the Democrats have a little bit of a lead. They have it a major source on their agenda to have AOC as their spokesperson for this green project, okay? So we want to be a little bit conscientious, at least in terms of psychology, with this wind, solar, biomass, even though, yes, we know crude oil and nat gas are at very low prices. It's where is the government going to send the monies to? And lastly, this sounds really boring, non-durable household products. Food, we mentioned that. Cleaning products, slam dunk. But packaging and containers, there's a lot of little hidden sectors out there. And I just wanted to start off with a weekly chart of something that's a super low priced stock that I think has lots of potential. What I like about this PLL, Piedmont Lithium here, is the fact that you've got this higher low on this nice little oscillator here turning up. That reflects the higher low on the weekly charts. And this is one of those stocks that is not marked up yet, but in the pursuit of electrical energy and batteries and this whole new field that obviously Tesla's got the upper hand on. You know, you might just snoop around the corner and see what other little gems could be there just waiting to be discovered. So this is a weekly chart of something that is just coming to life. You see this volume spike here, and it's just coming to life. So there is opportunity there. And keep in mind, if you buy a $6 stock and it goes to 10, that is one hell of a percentage return. Okay, here's another little interesting stock, totally different structure. I just want you to stay open-minded to some opportunities out there that are not the FANGs. This originally started off as an Israeli company, but they have headquarters in the US, and they are a very well-run company, solid. You can judge by the steady grinder trend. I like these grinder trends. Okay, so it had a little downdraft there, but this is one of the strongest type of chart patterns because it's not drawing attention to itself, and these are the things that can still go parabolic. So I love charts like this. And they, of course, deal with cloud-based computing, data security, internet security, data analysis, all sorts of areas there, which we are just seeing an explosion of going forward, okay? Solar Edge Technologies. I don't know about this company as much, except that I love companies that have taken out that little high from first quarter, okay? And I love the consolidation that it did up here. And I see a lot of attention and resources that can be directed in the future to these renewable energy shares, as they're called, wind, solar, huge advances in the technology there, okay? So solar is not what it was 10 years ago. It is so much more efficient. And then I had to throw this last chart in here as Wayfair because it goes to this online product ordering, okay? You can basically get just about anything on Wayfair now that you would expect to find on Walmart, which made great forays into the internet business, and of course Amazon. But this had one of the best percentage returns. Yes, you too could have bought this stock at 30 and now it's 228. And it's never too late to buy. So that's my thesis with this. It's our business model has changed. And don't look at the 30 and now it's 228. Don't ever do your analysis like that. Chop off this data. And instead, what you need to do when you do your analysis is look at the previous highs. 151. Okay, that was the high for 2018, 2019, 173. This last high, 197. This is kind of an orderly march up on these new highs. So let's just, I wanted to throw in a slide and say, stay away from the dark side. There are a lot of zombie stocks out there, and you will see it in the weekly charts, and they have a bad tendency to influence our analysis, okay? Don't look at this stuff. Zombie companies are those which would not be in existence without the support of government contracts and subsidies and so forth. So I have to throw this into the category of the zombie companies. So just to summarize my outlook for 2020, it's a sea of liquidity out there. Where is it going to flow? You've got commodities, you've got international markets going into, and some of these other sectors that I just mentioned to you. The seasonals and cycle work suggest we can hold into that middle of September. We could see a 6-week downdraft as people get nervous about elections. It would be only natural to see an increase in volatility there. Monetary conditions, plus. Money needs to find a home. Avoid the dark side. And lastly, there's lots of signs of sneaky inflation manifesting its ugly head out there, from raw materials, food, drugs, and healthcare. Thank you so much, Linda Raschke. My website, lindaraschke.net. Wishing you the best for the second half of 2020.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.